Another day, another story. Hello, and welcome to Finanso. Today, we're going to delve into a topic that affects everyone, from consumers to investors: inflation. In this video, we'll break down what inflation is, why it matters, its impact on your finances, and some strategies to navigate it successfully. So, let's jump right in. First, what is inflation? Simply put, inflation is the rate at which the general level of prices for goods and services rises, and subsequently, purchasing power falls. It's like that invisible force that erodes the value of your money over time. Inflation doesn't just happen randomly. There are various causes, but the most common are demand pull inflation. This occurs when there's an increase in consumer demand for goods and services, often fueled by economic growth and increased consumer spending. Cost push inflation. This happens when production costs, such as wages or raw materials, rise, and these costs are passed on to consumers through higher prices. Built-in inflation. This type of inflation is related to the expectations of future price increases. For example, if workers expect higher wages in the future, it can lead to higher prices. So, why should you care about inflation? Well, inflation has several significant implications for your finances and the economy as a whole. Purchasing power. As prices rise, the purchasing power of your money decreases, meaning you can buy less with the same amount. Savings and investments. Inflation can erode the real value of your savings and investments over time. If your investments don't outpace inflation, you're essentially losing money. Interest rates. Central banks use interest rates to control inflation. When inflation is high, they may raise interest rates to cool the economy, which can affect borrowing costs and your mortgage or credit card interest rates. Economic stability. High inflation can create economic instability, impacting business decisions, and potentially leading to financial crises. Now, let's talk about how we measure inflation. The most common metric is the Consumer Price Index, CPI, which tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It's a way to gauge how the cost of living is changing over time. For investors, inflation is a critical consideration. Here's how it affects various asset classes. Stocks. In general, stocks can act as a good hedge against inflation because companies can raise prices or expand operations to combat rising costs. Bonds. The purchasing power of the fixed interest payments on bonds can be eroded by inflation. So, rising inflation can negatively affect bond prices. Real assets. Real estate and commodities like gold often perform well during inflationary periods because they have intrinsic value that can keep pace with rising prices. Now, let's talk about what you can do to combat the eroding effects of inflation on your finances. Invest wisely. Diversify your investment portfolio with assets that historically perform well during inflation. Save and invest regularly. Regularly contributing to your savings and investment accounts can help your money grow and keep pace with inflation. Adjust your budget. Be prepared to make adjustments in your budget when prices rise. Prioritize needs over wants. Consider TIPS. Treasury Inflation Protected Securities, TIPS, are government bonds designed to protect your investments from inflation. In conclusion, inflation is a financial force that affects us all. Understanding its causes, consequences, and how to protect your finances from its effects is crucial. If you found this video helpful, don't forget to like and subscribe for more informative content. Thanks for joining us today, and remember, knowledge is your best tool for navigating the world of finance. See you in the next video.